He has the largest hedge fund in the world. He recently put out a post on studying the last 500 years of the global financial empires and basically bubbles in the debt cycle. Who am I talking about? I'm talking about Ray Dalio, and I'm talking about Bridgewater, everybody. Basically today I've got some info for you with respect to Ray Dalio and the Bridgewater hedge fund, right? So first off, I'm going to show you what their portfolio looks like in 2021. At the time of this recording, it is March 18th. It's Thursday, March 18th, and we got some pretty big correction days, some pretty big red days. There's a big red day today for the NASDAQ and a lot of the tech stocks. So we've got a lot of, we got some green days too, of course, but it's kind of like 2 steps forward and 3 steps back since the middle of February. And I'm very interested in what Ray has to say because he has a lot of thoughtful commentary about Bitcoin. He's certainly not all in, but he's got a lot of thoughtful commentary about it. And, as does Bridgewater, different, people from Bridgewater and their commentary about Bitcoin and how it is, a gold alternative or a digital gold. And they're not necessarily putting their institutional clients in it yet, but they've got a lot of thoughtful commentary. So I want to know what he's thinking, and I want to deliver that to you all, okay? So basically, number 2, I'm going to show you Number 2, I'm going to show you key changes that they made in 2021. Number 3, I'm going to show you their quarterly performance going back to pretty much early 2019. Number 4, I'm going to show you how Bridgewater is doing against the S&P 500 over the last 5 years, 3 to 5 years. And then also I'm going to show you I'm going to save it for the very end, but basically what is, what Ray calls the Holy Grail. So it's actually a really good video that he talks about really analyzing and then also demonstrating to us the importance of diversification and really how he takes, different asset classes and different assets that don't have any correlation, and showing you how he really reduces his risk and increases his probable return, and thereby also reduces his risk of losing money, by investing in different assets that are not correlated, right? And he calls it the Holy Grail. So it's the last little section here. It's a bonus section for you. So let's take a look real quick. I'm going to do a screen share. Number 1, super simple. Let's take a look at the portfolio here. So right here, this is Bridgewater, and it's about 12 billion right now, right? 422 positions. Lots of positions here, as you can see. Basically S&P 500 ETF at 9%. We got right there after that, emerging markets. As you can see, very very diversified. Lots of ETFs that they have here. So these are their positions. Then after this gold trust ETF, they go into some individual positions. This is a China position, Pinduoduo, and then Coca-Cola, Johnson & Johnson, Pepsi, obviously, then Costco, McDonald's, lots of ETFs, JD, that's a China company. And then let's go to number 2. We've got key changes. So we got key changes right here. Basically, let's take a look at what doubled, right? They doubled their position in 2021 on P&G. They doubled their position in 2021 on Walmart. They doubled their position in Coke, J&J, McDonald's, Pepsi, and Costco. I actually have a little bit of Pepsi. That's definitely worth taking a look at. I don't know about you all, but I don't own Walmart right now. But I think at this year, I think it's certainly something I would rather have than not. So it definitely is eye-opening in terms of taking those positions. I already have a little bit of McDonald's. I shedded some McDonald's to make the way for some growth tech and some tech stocks. And then if you take a look at it, let's reduce this a little bit. So it is wonder why. Yeah, I guess it's they did a little bit of a reduction in their S&P 500 ETF. Pretty big reduction in their gold. And then a 70% increase in their emerging markets, right, in terms of their key changes for 2021. Okay, so let's take a look at some of their quarterly results and how they've done quarter by quarter. So if you take a look right here. So what's kind of funny, if I actually said Q4 2019, which I was mistaken in one of my other videos. It's really Q1 2019, right? So from Q4 2018. Looks like they peaked at over 15 billion in their fund in Q1 2019 and then went all the way down, oh my gosh, all the way down to 5 billion. That's a pretty massive drop, right? From Q1 2019 to Q1 2020, from over 15 billion to, that's a lot, an asset value of a loss of 10 billion. That is pretty crazy. Down to 5 billion in Q1 2019, and then a steady increase, right? All the way through pretty much Q4 2020. A lot of folks did good in 2020, right? But a pretty steady increase up to where it is now, in between 11.5 and $12 billion as a fund. And that's their quarterly performance. Let's take a look at how they do against the S&P 500. Let's go in right here. So this is them against the S&P 500. Again, this is just their top 100 positions. So, obviously they've got more than 100 holdings, but this is their top 100 positions. So as you can see, they're pretty much stacking. So the overall 5-year comparison is 190.12% compared to S&P at 102.85. So as you can see right here, pretty much in right there in around beginning of 2020, they started to kind of, blow past them. So, 90% better than the S&P 500 over the 5-year time frame is what they're looking at. Pretty awesome. And then let's go into the Holy Grail. So basically what this is this is going to be a video clip that I found for you where, Ray Dalio talks about, really about his strategy. It's actually a little complicated, but he talks about his strategy and how he's, like I said, he's reducing his risk it's about the importance and the value of diversification, right? And it's about, how he reduces his risk by investing in assets that are not correlated, and then how that then thereby, reduces his risk of losing money, and then thereby also increases his potential return. So let's go ahead and take a look at that. And, I really have a feeling you all are going to like it because he calls it the Holy Grail. Diversification.
The real question for me was, what were the marginal benefits of diversification like? What is that going to look like? Okay. And what I then decided to do was to think about risk and the number of sample size and the correlation of the bets, broke it down to each of its components, right? So to use an example, let's assume you have, to make it simple, a return, something that has a 10% risk. We'll call risk standard deviation. And let's make it simple, and let's say it had a 10% return. And let's say I add in another asset, another return stream. I add in a second, a third, a fourth, a fifth, up to whatever number. How would that reduce my risk if it on average has a 60% correlation? Or if it has on average has a 40% correlation, or a 0% correlation? How would that change? Wanted to know that, right? So that's what this chart shows, right? And so, so imagine you have a 10% average return. You don't know which bet is going to be better. Has a 10% average return and a 10% risk. And you add in a second and a third and so on. You're not going to lose the 10% because you're still going to have that 10% return, but you're going to then have a reduction, and that's the reduction in risk. And if it has a 60% correlation and you have 3 or 4, you will get a reduction that maybe is about 15%. And you could add in 1,000 if they're 60% correlated, and you're not going to reduce your risk much. Okay, that's important. Now, if I look at that, how that changes according to the levels of the correlation, I start to think, well, what would happen if I added in something that had a 10% correlation, by way of example? Okay, now that's what that line shows. Okay, and it shows how much, okay, at about 7 or 8 or so, I cut my risk in half. That means I've doubled my return relative to my risk, right? Ooh, that's good. So as I go down this, I then start to understand what the power of diversification is in terms of the things that I'm going to look for. So what that taught me is the magic is you only need to do this simple thing. The simple thing is to find 15 or 20 good, uncorrelated return streams. Things that are probably going to make money, but you don't know, but have a good probability of making money, and that are uncorrelated, that have low correlation. That told me that's what I have to go after, right? That's the key. A lot of people think that the most important thing you can do is find the best investments. Okay? That's important, okay? But there is no great one best investment that can compete with something like this. So look at this line. When this comes down, you can improve your return to risk ratio by a factor of 5. Right? 5 times the expected return for that unit of risk. You can't pick any investments that are probably, nobody's humanly capable in an efficient market probably, to pick investments that are 5 times as good individually, but so that bad. So it tells me about the power of diversification and balancing risk. So this is the return to risk ratio that happens for each one of those. You know, like if I can get 0 correlation and I have 15 to 20, I'll have an information ratio, a return to risk ratio of 1.25. That means my probability of losing money in a year is only 11%, okay, as distinct from 40% with any one of those. So that's the power of portfolio construction and the power of diversification, okay? So it tells me what I have to go after.
So there you go. That's some pretty technical and powerful speech there. His Holy Grail on diversification, and you know, it's pretty impactful. I mean, it really makes me think. I mean, I certainly have found that diversification is huge. Really, just in terms of just diversifying away from one stock. But if you think about it, I've got a lot of exposure to a lot of the tech stocks. And then also kind of, came in with a little bit of exposure to ARK, some of the ARK ETFs. I have exposure to ARK Next Generation Internet and then ARK Innovation. The reality is a lot of these investments that Kathy Wood and ARK investing in are really similar to what I already have stocks in. So in a way, they're pretty correlated, right? So it's pretty powerful, take instead of just, limiting your exposure to one particular position, really, find a way to find 15 or 20, uncorrelated assets, which that's kind of that's definitely like a long-term, a great long-term goal. I think that it might be a little bit hard to start out, and have 15 uncorrelated assets. I mean, I think, to really kind of keep, just to keep in mind the concept of just, really, if you are excited about something, if you're excited about a company and you want to make an investment in it, really reduce that risk, that exposure to something like, 1 to 2.5%. Don't really go up to 2.5%. And really, time is going to be your best way to kind of measure the results, right? Whether they're bad or they're good. I mean, time is going to be what you use to measure results, really. And then as your results start to show you if your selections work, then you can increase it over time. So hopefully you all like that. Hopefully you guys, everybody like that. I've got a lot of different videos, on Ray Dalio. I'm going to put them in the description area so you can see those other videos. I also, so I pretty much covered, their performance and such. But any other videos I'll put for Ray in the description area. And hopefully you appreciate that value. It's March of 2021, and traditionally March is a pretty volatile month. So I do find it important to really go back to folks like Ray that have a lot of wisdom and see what what they're doing with their portfolios and what their key changes are for the year, and then share that with you all. So hopefully you liked it. If you have any questions, put them in the comments below and let me know if you want to see some more videos on Ray, or what sort of videos you want to see. Also, I'm going to put a link below. I've got a blueprint, everybody. I got a blueprint. It's very economical. I talk about investing, online income, credit, business credit, financial independence, and I got a guide at the end. It's like a 15-page guide. All the groups in the U.S. that provide a free credit score, and then all the groups that provide a free FICO and the corresponding bureau. Yes, a free FICO for Experian, Equifax, and TransUnion. And my guide is only $7, everybody, so that way you don't ever have to pay for a FICO again. And a lot of times you got to go and pay monthly for a FICO. If you have any questions, let me know. Have a great week. Thank you.